July saw a slight uptick in consumer spending, with household use of credit and debit cards up 0.1% during the month. Both Barbenheimer and back-to-school spending played a part in the increase. That's according to recent analysis from Bank of America. Now, while some high earners may face pressure from slowing wage growth and a cooling labour market, most remain resilient. But can August continue the upward momentum? David Tinsley, senior economist for the Bank of America Institute, joins me now to break this down. Thank you so much, David. So let's talk about this July data, because there's a few factors in there in this consumer checkpoint that make things a little bit different from your typical June month as we saw.
Yeah, thank you for having me on. You're exactly right. So July was very solid in our data, and we have a perspective from 68 million Bank of America customers. So it's a very good barometer, we feel, of the US consumer. And our data showed spending on the month up 0.7%. Good momentum, and really interesting that services and goods, the retail side, both strong. But there are some specials, if you like, in the month, as you're referring to. One was the early July 4th holiday. That looked in our data to be very solid. Then there was some mid-month online promotions. And then, really interestingly, of course, we had Barbenheimer at the end of the month. And when we look at our data, July was solid for restaurants, eating out. It was also solid, interestingly, for clothing. So maybe people were getting that pink gear in ahead of going to the movie theatre. So a few specials, but overall, the resilience of the consumer continues to look, really reassuring, I feel.
And there does seem to be this tale of two consumers that was noted in the report. Your affluent consumers there feeling the pinch more than lower and middle income. Why are we seeing that disparity?
Yeah, that's really interesting. So what we can do with our data is we can look at the wages and salaries going into customers' accounts, households' accounts, and tier them by income. And when we do that, we see that higher earners, higher income households, their wages and salaries growth is pretty much flat relative to a year ago. And for middle and lower income, it's sort of 2, 3 percentage points higher than that. One of the reasons seems to be a slower labour market at the top end. When we look at unemployment payments into people's accounts, we see them rising 3 times faster for higher earners than for lower earners. So perhaps some of the stories around tech layoffs, financial sector layoffs are at play there. And I think that's probably the main drivers. I mean, the good news is that really across all income tiers, there's still quite a lot of these deposit buffers in people's accounts. In other words, relative to 2019, people continue to have raised levels of cash. So hopefully the downturn we've seen to date at the higher end is already largely behind us.
And David, how sustainable do you think the savings buffer is? Because at the same time, we're also seeing this rise in credit card debt as well.
Well, the savings buffers are there. They're up across all income cohorts, sort of 30%. And if you're looking at households earning below 100K, they're up sort of 50%. They are trending down pretty slowly, but it really is very slowly. And we did some simple scenario analysis in our consumer checkpoint in which we projected forward. We projected forward in a hypothetical sense where those buffers would go if they carried on decreasing at current rates. And if you do that, you get well into 2024 before the buffers reach 2019 levels. So, the dynamism on the consumer side of the US economy looks pretty resilient, really, I'd say.
And so then, as you check in on the state of the consumer, especially on the heels of what we saw with the hotter than expected July retail sales data, how long do you think the consumer can stay this resilient?
Well, I think it comes down to, as everything always does, the labour market. So while the US labour market remains in pretty good shape, and of course there has been some slowdown in payrolls, but it's relatively modest to date, then I think as consumers really see their labour income rise at a steady pace, they will continue to spend. We might get the odd month of retreats, but by and large, the second half of the year should be pretty solid. So, I'd be pretty upbeat about the momentum going into the end of this year.
And we did obviously, coming out of COVID, a lot of focus on spending on goods, but we are seeing that shift then to services. Do you expect that to start balancing out at some point? Or is it really going to be about what people are willing to spend on services?
Well, we saw this rotation away from goods towards services all last year and into a good chunk of the start of this year. So people started going to the movies to watch Barbie, etc., and more. They were buying less goods. Actually, just recently in the data, the goods spending seems to be bottoming out and coming back a bit. So, that's early days. It's early days, but there are some signs really that rotation may have largely played out. And so from here, you might get a much more balanced picture of goods and services spend.
We'll certainly be keeping track of that. A big thank you there to David Tinsley,
Thank
Senior
you.
Economist for the Bank of America Institute. Thank you so much.